the S&P 500, the NASDAQ 100, the dollar, the bonds, the VIX. We're going to take a look at everything, even the Fed balance sheet, so that we can get a good holistic view of what is happening in the market, so that I can explain my thought process of what the next steps are. All right, so without further ado, let's get started with the video. All right, so what this website is that this is the CME Group's Fed Watch Tool, which shows the target rate probabilities for different dates. So it's basically, you can see that it shows the probability of a rate increase or decrease. So currently we're at 500 to 525 basis points. And there is a 75% chance that in June, the rates are going to be paused. Okay. So an increase in rates is bad for the stock market. A pause in rates is good. So when the rates increase, that means that the price of stocks should be decreasing. Okay. So we can see that in June 14th, 75% chance that we're going to be paused. Only a 24% chance that it's going to increase. Okay. Now by July, that percentage increases. So we saw that it was a 25% chance for a rate increase in June. In July, it goes up to 33%. Okay, so there's a 33% chance that we're going to get an increase in rates by July. And that is not really that's not a bullish sign. And this July number was almost like close to 100% a few weeks ago. So the fact that it's starting to, it's not starting, but it's really starting to lower is not a bullish sign for the overall market. Okay, once again, I just want to hammer it home. Increasing rates is bad for the stock market. Increasing rates means that the price of the SPY, Apple, these larger stocks are going to fall. Okay, so that's number one. All right, so the next most important thing that we have to take a look at is the debt ceiling, because that is the most important thing at the moment. And I'm just trying to paint a nice picture for you guys to understand the climate of the market. All right, so Goldman Sachs says that the US has an extra 8 days before it runs out of money to pay its bills, which is mind-blowing. That could buy it more time to negotiate the debt ceiling. So Grandma Yellen, the Treasury Secretary, said that the X date, or the date when the US can no longer pay its bills and risks a default, is June 1st. But according to Alec Phillips, in Goldman Sachs, chief political economist, he says that our guess right now is that the real deadline is probably more like June 8th or 9th. That's when they're sort of at greatest risks. This is ridiculous, obviously, but basically the Democrats and the Republicans have remained locked in an impasse over raising the $31.4 trillion debt ceiling, which means the US can run out of money as early as June 1st. Blah, 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 right? And basically, at the moment, Insider Phillips said that the Treasury general account balance fell to $57.3 billion on Thursday, the lowest since December 2021. That's about a fifth of the federal government's $316 billion cash balance at the end of April. So the Treasury account of the United States only has $57.3 billion as of Thursday. And it's rapidly declining. It's dropped dramatically since the end of April. And so this website shows how much money is in the US Treasury's general account balance. And currently you could see that it's close to $68 billion, right? Back at the end of April here, it was close to $300 billion. So you could see a sharp decline. You could zoom in here and you can clearly see the trajectory of the US balance, Treasury balance has been sharply decreasing. And we're at a very substantial low here. A low that we haven't seen since December of 2021, as the article stated. So this is obviously not good. We need to see some sort of an agreement with Congress. The Democrats and Republicans need to come to some sort of agreement, or the US is going to default. And what I was talking about in yesterday's video was that when people know that something needs to happen, especially in Congress, say for example, a road needs to be built in a state, and someone is trying to get a bill passed for funding for that road, right? And a Democrat, say for example, a Democrat wants to get whatever party it is, one party member wants to get funding for a road in a different state. The opposite side, so if a Democrat is asking for a road to be built in Arkansas, then a Republican is going to ask for housing permits in something completely irrelevant to the bill in a different state, because they want to get something out of the deal as well. And they know, so one of the issues is that doing this and coming to an agreement for the debt ceiling is going to look good for Democrats, because being able to come to an agreement during a Biden presidency is going to be good. Obviously, Republicans obviously don't want that. So they're trying to get as much out of the deal as possible before they pass it. And that is currently the predicament that the US is going through at the moment. And the next thing that I want to take a look at is the balance sheet of the Federal Reserve. So this is the total assets of the Federal Reserve. We can zoom in here, and we can see that at the end of March, we saw a sharp increase in assets of the Federal Reserve. And this also coincided a bit with a low in the S&P 500. So we saw a sharp increase in how much money the Federal Reserve had on its balance sheet. And since the end of March, we've seen a steady decline almost back to the initial pop. So the balance sheet of the Fed is decreasing. The balance sheet of the US Treasury is decreasing. We're very close to a major debt crisis in the US economy, and the stock market is increasing. So that doesn't really make that much sense. All right, so I'm trying to give you guys a holistic view of everything that's happening. The macro factors are not working. The macroeconomic factors are not, they're like genuinely not helping an increase in the stock market. And just to top it off, not even mentioning that bond yields and the bonds are at all-time high short interest. So if people are very, very bearish on bonds, that's also not good at all for equity prices. But equity prices, you could see that there's a divergence. So we're going to take a look at that as well. So before we start going into the fun stuff, we start looking at the technical analysis for the stock market, right? We really need to look at the bond ETFs. So what I first want to look at is the tip. So this is basically the bond ETF. It's showing extreme weakness. And we know that bonds generally move correlated to the market. So if the bonds are falling lower, then that means that the stock market should also be falling lower. The fact that the bonds are falling this low while the stock market is basically at 420 and it's making new highs, etc., this divergence is generally not good at all. The fact that this divergence is happening is not bullish. Next, this is the 30-year bonds that we look at often, right? Again, you can clearly see this is hitting lows and lows and lows. We are selling off like crazy here on the bonds. And once again, correlated market. If we're falling on the bonds, we should be falling on the stock market. Generally, that's what ends up happening, but currently that's not the case. And this is this divergence should not be happening. It does not help stock prices. And just to drive this home, we are short bonds at an all-time high. This is the aggregate net speculative positioning in US Treasuries. We are at an all-time high in terms of shorting the bonds. So obviously it's not bullish for the bonds here. All right, so that was a lot to digest, but you basically needed to see how everything was put together, because we're getting very close to a very important point in US history. So currently right now we can see that the NASDAQ continues to be a big reason why the market rally. All right, so clearly when you're looking at any of these tech stocks right now, Microsoft hit another all-time high. Google hit another high today. Apple didn't do too well, Tesla skyrocketed today. So these larger tech stocks are doing really, really well. Meta did really well also. So not even to mention AMD and Nvidia. Right? So these large tech stocks generally were doing very well. We could see that there's some weakness coming out of Nvidia and Apple, but regardless, these other stocks are continuing to do well, while the macroeconomic backdrop of the economy is very, very poor. So now the question is, how much higher can this continue to go up until we fall, right? Over time, this is not a bullish market at the moment. Like, we could continue going up higher, but overall in the next few months, we should not be exceedingly bullish for like months horizon, weeks and months horizon. Day to day, a lot can still happen. Things can still change. Intraday, I mean, we made two 60% trades back to back, and our GME calls are up over 100%. So I mean, like day to day, like things can happen regardless. But I'm talking about in terms of horizon of what's going on with the market in general. This is not a bullish structure for the market. This is not really what we want to see. Okay, so currently, we can clearly see that the NASDAQ is still not closing above the highs. This is continuing to wick, but this doesn't automatically look too bearish, right? Where we held the support. I was saying that 334, 335 area needed to hold and bounce. And currently it looks like we are bouncing, but we need a solid close above now, but we're teetering, right? And the other tech stocks were obviously doing really, really well, Microsoft, Google, but we're starting to get very overextended in these other tech stocks. For example, Tesla, starting to look very, very overextended. Nvidia is not showing that much strength. It's continuing to fall. So we need to see how these basically companies are going to end up doing heading into like the next few days specifically, because Wednesday we also have FOMC minutes. So, and Wednesday morning, Treasury Secretary Yellen is also going to speak. So this is very, very historical times in the market. If you are following the market day to day, take the time to do the necessary work. Obviously, it could be very daunting. It could be very, very overwhelming to know about all of this information, blah, blah, blah. But you will thank yourself years down the line when you are doing this work now. Years and years down the line, moving forward, you're going to thank yourself for doing the work, because you're going to know what to look for. You're going to know what information to look for. Everything. It's going to be great. So just take it slow, keep it up, and yeah. So that's that. But anyway, the NASDAQ, right? We haven't broken above yet, right? The IWM had a really, really big day today. It was the biggest winner. We bounced off of support. We gapped up and we were bullish on the IWM today, right? But then we were looking at the SPY. The SPY had a pretty flat day today. We shorted the bottom on the SPY, then we went long, and then we shorted again. But it was basically very flat on the SPY. 420 is still acting as a major level of resistance. And I was showing how 421.25 is a gap that needs to be filled in the SPY. Now, this is still clearly, this is still bullish, right? This still looks bullish. We're holding support, but tomorrow is going to be very, very important. Tomorrow, if we're going to continue up, it needs to happen tomorrow. So depends. If we end up gapping up a bit, we could play long in the early hours of the market, but we have news at 9:45 a.m. and then at 10 a.m. Keep that in mind. But regardless, this is doing technically what it needs to do for another move up. Now, what we want to see is we need to see the move up happen tomorrow, in my opinion, because the longer we wait here, then it becomes just a setup to go short. And that is what my thought process is for the SPY right now. We need a fast move to the upside, and we need the strength out of tech and the Russell to help pull this up, but currently it was flat. So if tomorrow and then specifically Wednesday we don't get a big move to the upside, then this is going to end up falling back down to 414, 415 area, because the longer it stalls out up here, if we continue to stall out at a level of resistance, 420 is a major level of psychological resistance. All right, if we take too long to break to the upside, this goes the same in the 1 minute time frame, smaller time frames, everything. When you're scalping, if you take too long to break above a level of resistance, then there's always going to be a breakdown below support. From here, once people end up going short, then we end up getting a bit of a bounce here, and from this bounce, that's when things will need to have a decision. Are we going to just is this going to just be a bear trap where people just go short? They made it look very, very bearish for a reason, and then they rip it up and rip it back up above 420, or is this going to be another short opportunity off the bounce and then continue to move down? But regardless, the highest probability chance is that we end up failing at this level of resistance if we don't get a bounce tomorrow. If we don't break above tomorrow or Wednesday, then this is going to this very, very high likelihood chance that we break below 417. And then as we break below 417, that's when things could be very, very dangerous to be a bear, because they could easily just rip it back up. Because we have to be pragmatic. This is still a lot of buying pressure in equities. And yes, credit spreads are widening. Yes, interest rates could potentially continue going up higher. But equity prices are rising. And we could clearly see there's a huge divergence between bonds and equity prices. So in the short term, the price of the stock market can continue going up a bit higher. But in general, right? Yesterday I was showing you guys how in detail, based off of the past, generally the next few months should be bearish. It doesn't need to be automatically overnight, and a lot can happen, intraday, whatever. But generally, we're at historical shorting volume. Basically, the positioning should be short, like historically, and that means that the next few months should end up falling lower. And yeah, I hope I did a good job explaining everything to you guys here. And there's a lot to see what ends up happening in the next few days, but day trading wise, swing trading wise, we're on the right side of the market each and every time. We went 3 for 3 today, not including the GME swing. I was showing how GME was going to be a very, very big winner for May. We went long GME down here, and GME is up from this point over 25%. So it was up over 100% depending on the contract that you bought. So yeah, I mean, we're catching all of these moves regardless, and it is what it is. For the macroeconomic view of the SPY, the NASDAQ, etc., we just have to take it one day at a time. So I hope you guys enjoyed the content. Please make sure to like, comment, subscribe, do all that good stuff. I really, really appreciate it. It means the world to me for all of your support. And please make sure you guys subscribe to the YouTube channel, because I'm going to be going live exclusively on YouTube soon. So please make sure you guys are subscribed to the YouTube channel and put on your bell notification. All right. So without further, with that being said, I hope you guys enjoyed. Take care. Have a spectacular Monday. I will see you guys bright and early tomorrow. Thank you.